Okay, chapter 23 is looking at incremental analysis. Managers are faced with a lot of very short-term, day-to-day decisions, and they have a lot of information available to them. And in different managerial decision situations, managers need to be able to determine what revenues and expenses are relevant to the decision they're making and which types of revenues or costs they can ignore, and they have no impact on the decision at hand. And ultimately what it comes down to is determining what is or is not relevant. So we're going to look at a whole bunch of different scenarios here, and we're going to continue to apply the concept of relevancy. First problem we're going to look at is Stanton Incorporated makes unfinished bookcases that it sells for $60. Cost to produce those bookcases are $30 variable and $10 fixed. Because it has unused capacity, the company is considering finishing the bookcases and selling them for $72. In other words, they're considering further processing those bookcases, selling them for a little bit more. The variable finishing costs in order to further process are expected to be $8 per unit and no increase in fixed cost. We are going to prepare an analysis on a per unit basis showing whether it's financially worthwhile for Stanton to sell the unfinished or finished bookcases. Okay. So ultimately, this decision is going to be based on which is more profitable for the company. Whichever method produces more of a profit is going to be the method the company would choose. Easy way to set it up is to compare the profits if we sell the product as is without processing further, or what the profits will be if they choose to process further. If they choose to sell it as is, they will be selling each unit for $60 a piece. The cost they will incur in order to create the unfinished product is $30 in variable cost and $10 in fixed cost. So for each unit, $30 plus 10, total expenses of $40. If they sell as is, their profit is $20 per unit. If they choose to process further, the revenues will be $72 per unit. Their variable cost to finish will cause the original variable cost to go up another $8. Thus, the variable cost will go from $30 up to $38. Their fixed cost will not change, so fixed costs will remain at $10, bringing their total cost up to $48. On a per unit basis, the profit per unit is $24. Because there is an increase of $4 profit if they choose to process further, they should go ahead and process further because the additional revenues they will earn exceed the additional cost. That's what we mean by incremental. The additional revenues exceed the additional costs by $4 per unit. Now, what we're going to find with all of these decisions is that we can focus on the quantitative analysis. By quantitative, I mean the financials, the money. But every time managers make a decision, they need to look beyond the financial, look beyond the quantitative, and they need to look at the qualitative aspects as well. For instance, in this situation, even though it might be financially better to process further, maybe they need to consider the qualitative aspects of what customers want. If a majority of their customers want an unfinished bookcase because they like to finish it themselves, it probably wouldn't be as great of an option to go ahead and process further and finish them because they might lose customers. Okay, so there's a lot of things that they need to consider beyond just the quantitative. Let's take a look at another example of a type of decision that managers are facing. This company manufactures toasters. The first 8 months of the year, the company reported the following operating results while operating at 75% of plant capacity. They sold 400,000 units incurring the cost of goods sold of $2.4 million, a gross profit of $1.6 million, operating expenses of $900,000, and a net income of $700,000. Of the cost of goods sold, 70% of that cost was variable and 30% was fixed. The operating expenses of $900,000, 60% are variable and 40% are fixed. In September, the company receives a special order from a customer for 40,000 toasters. The customer offers to buy them at $6 each. If the company accepts the order, they will incur an additional $8,000 of shipping costs, but no increase in fixed operating expenses. So this is a decision of, do we accept the special order from the customer or not? Decision is going to be based on whether this special order will increase the company's profitability. At first glance, if we take a look at the current selling price, their normal sales are $4 million. When they sold 400,000 units. They normally sell each unit for $10 a piece. This customer is offering to buy them for $6 a piece. The company's trying to decide if it is financially beneficial. So we're going to prepare an incremental analysis for this special order. The company has two choices here. It can reject the order, or it can accept the order, whichever one provides the best financial benefit. If they reject the order, they will have no additional revenues. They will have no additional cost. There is no impact on their profits. However, if they accept the order, they will bring in 40,000 units at a selling price of $6 each, or revenues of $240,000. In order to fulfill that order, they will need to make the additional toasters. In order to make the toasters, they have to make them. They will have to incur variable cost. They will not incur the fixed cost because there is no increase in the fixed cost. They have the capacity to fulfill this order without having to buy more equipment or pay more supervisors. Okay? Because they're operating at 75% of plant capacity, they can still make more without affecting their structure. Okay? Thus, there will be no increase in fixed cost, but they will incur the variable costs, the variable cost of goods sold, and the variable operating expenses. Okay? Taking a look at the variable cost of goods sold, total of $2.4 million in cost of goods sold, of which 70% are variable. Normally, they incur $1.68 million in variable cost of goods sold, and they sell 400,000 units, resulting in a variable cost of goods sold per unit of $4.20, which means in order to fulfill this order, they will incur $4.20 for the 40,000 toasters, additional variable cost of goods sold of $168,000. For their operating expenses, $900,000 total. Of the $900,000, 60% were variable. $900,000 at 60% means $540 of their normal operating expenses are variable. Those operating expenses were incurred when they sold 400,000 units. They have a variable operating cost of $1.35 per unit. In order to fulfill this order, we'll incur $1.35 for the 40,000 units, or variable operating expenses of $54,000. In addition to those, they will incur more shipping costs as well. This is an incremental shipping cost. Thus, the total operating expenses that will be incurred associated with this order are $62,000. order will bring in revenues of $240. It will incur expenses, leaving them with a $10,000 net income. If they reject the order, no impact on income. If they accept the order, a $10,000 increase to income. They would choose from a financial standpoint to accept the order because it increases their overall profitability. Quantitatively, adds to profits. Now let's talk qualitative. If they accept this order, they're accepting an order from a customer selling the product at a lower price. What impact might that have on existing customers? What if existing customers find out about that order and they're upset or they demand a lower price as well? That's going to impact this company's normal operating profits. Also, maybe it'll spark a price war where competitors start dropping their prices to match what this company is doing. That will cause this company to have to consider dropping their prices moving forward. There's a lot of qualitative things that need to be considered outside of the quantitative. Okay, let's apply this concept of relevancy to another problem. Shannon has been manufacturing its own shades for its table lamps. The company is currently operating at 100% of capacity. Variable manufacturing overhead is charged to production at a rate of 50% of direct labor cost. The direct materials and direct labor costs per unit to make the lampshades are $4 and $6 respectively. Normal production is 40,000 table lamps per year. A supplier offers to make these lampshades for the company and charge them $13.50 per unit. If Shannon accepts the supplier's offer, all variable manufacturing costs will be eliminated, but the $40,000 of fixed overhead currently being charged to the lampshades will have to be absorbed by other products. Okay. They're trying to decide whether they should go ahead and continue making the lampshades or buy them from a supplier. The decision process here is to figure out which option is least expensive for the company. In order to do that, we will compare the cost to make it to the cost to buy it. If they choose to make the lampshades, they will be incurring direct materials and direct labor costs of $4 per unit for materials and $6 per unit for labor. 40,000 units at $4 per unit for materials, 160,000. Direct labor of $6 per unit, 240,000. In addition to that, the manufacturing overhead is charged at the rate of 50% of direct labor cost. The direct labor costs were $240, so the variable manufacturing cost will be 50% of that, or $120,000. Finally, $40,000 of fixed manufacturing overhead is currently charged to the lampshades. So we are incurring an additional $40,000 in fixed manufacturing cost. The total cost to make these lampshades, $560,000. Now, if the company chooses to buy the lampshades instead of make them, they will eliminate all variable manufacturing costs, which means we'll no longer be paying for materials, labor, or variable overhead costs, because they will be getting rid of all of those manufacturing costs. All of those will be zero if they choose to buy. However, the $40,000 of fixed manufacturing overhead is not going to go away. They cannot eliminate that, which means that $40,000 is still going to be there. It's still a company's cost. We'll have to pay $13.50 per unit in order to purchase those lampshades at 40,000 units, a total cost to buy of $540. The total cost to make are $560. The total cost to buy are $580. Based on this analysis, they should not buy the lamps, they should continue to make them. If we hadn't thought about this all the way through, the company could think, wait, it might be better to go ahead and buy them, forgetting that that $40,000 of fixed overhead won't go away. Okay? So right now, this is telling us to go ahead and make them. From a qualitative standpoint, though, we may want to consider quality. Maybe the supplier can produce a higher quality product. Qualitatively, it might make sense to pay a little bit more if the lampshades are of a higher quality. Okay. On the flip side, we also need to consider, from a qualitative standpoint, whether the supplier will be able to provide the lampshades to us in a timely manner. Will the lampshades be delivered on time when we need them? Or maybe the supplier is not real reliable. Okay, so quality and supplier promptness or on time is a huge qualitative thing to keep in mind when making these decisions. Let's apply this concept of relevancy to another problem, another managerial decision situation. Here, Felton has a factory machine with a book value of $90,000, a remaining useful life of 4 years. A new machine is available at a cost of $200,000. This new machine will have a 4-year useful life, no salvage value. The new machine will lower annual variable manufacturing costs from $600,000 to $440,000. We are going to prepare an analysis showing whether the old machine should be retained or replaced. If a company is trying to decide whether to keep an old machine or replace it, they're going to choose whichever option is least expensive for them. So we're going to compare the cost to retain the equipment to the cost to replace the equipment. The current machine has a book value of 90 and a remaining useful life of 4 years. That $90,000 is the book value, the cost minus the accumulated depreciation of the machine that they currently have that is sitting in their general ledger. That $90,000 is really a sunk cost and irrelevant to this decision, because whether they choose to keep or replace, that $90,000 is not going to change, right? It's sunk. A new machine is available at a cost of $200,000. This machine will have a 4-year useful life with no salvage value. The new machine will lower annual variable manufacturing costs from $600 to $440. If they choose to keep the old machine, their annual operating costs are $600,000. $600,000 the next 4 years. Operating costs of the old will be $2.4 million. The operating cost of the new are $440,000 over 4 years, or $1,760,000. In addition to the operating costs, if they go with the new machine, they will have to purchase it. So there's an additional $200,000 to purchase the new machine. Comparing the cost to retain, replace. Replacing the equipment is less expensive based on the savings each year they have in operating costs. Thus, the decision should be to replace the old machine. Quantitatively, it's less expensive. But let's talk qualitative. From a qualitative perspective, let's think about the impact of replacing a machine. One, it's going to have an impact on our labor. Maybe it will require additional training. Maybe our employees will have to learn new skills, a new machine, new way of doing things, which may impact the morale of our employees. Another thing that could be considered is maybe the new equipment we'll replace some of our workers. If we have to lay off some of our workforce, that may leave an impact on the remaining labor. The remaining employees may have a morale hit due to some of their colleagues being laid off. On the flip side, though, it could have the opposite effect. Maybe the new equipment helps the employees, makes them happier, makes them more efficient. Okay, so there are qualitative things to consider here as well. Okay, another big decision point for managers is, when they have multiple different products and they are trying to decide which product is the best financially to focus their efforts on. Okay, for instance, Freeze Company manufactures and sells 3 products. Relevant per unit data concerning each product are given. The selling price of each product, the variable costs and expenses to produce each of the products, and the number of machine hours required to produce each of the products. Some of the products require more machine hours to produce than others. Management has a limited number of machine hours available. They are trying to decide which of these products, A, B, or C, they should focus the machine hours on. The way we accomplish this is by figuring out which machine produces the highest contribution margin per limited resource hour. For instance, product A, selling price of 11, variable cost of 4, it has a contribution margin of $7 per unit. It requires 2 machine hours to produce. $7 contribution margin divided by 2 hours gives us a $3.50 contribution margin per unit of the limited resource. Product B has a contribution margin of $4 divided by 1 machine hour, contribution margin of $4 per unit. Finally, C, contribution margin of $6, 2 machine hours required, contribution margin per unit of limited resource of $3. Based on this analysis, the product that provides the highest contribution margin per hour of the limited resource is B. So product B should be manufactured because it results in the highest contribution margin per machine hour. Okay. Now, let's further that analysis to determine whether 3,000 additional machine hours that are available, which product should be manufactured. And we are going to do it based on the additional hours divided equally among the products, or whether we should allocate all of those machine hours to the product with the highest contribution margin. Okay. So in the first scenario, if we allocate those 3,000 hours equally across the 3 products, each one will get 1,000 machine hour time times its contribution margin per machine hour to get the total contribution margin that it will provide towards covering the fixed cost of the company. Total contribution margin of $10,500. However, if we apply all of those hours to the highest contribution margin per hour product, we will end up with 3,000 hours times $4 contribution margin per hour, or a total contribution margin of 12,000. If we divide the machine hours equally, the total contribution margin is 10,500. If we put it all to the high resource, the high contribution margin product, we get $12,000 of contribution margin. Based on this, we should go ahead and allocate the hours to product B from a quantitative standpoint. But qualitatively, management would also want to consider the impact of doing so on product demand. What if customers are demanding more of the other products? Then it wouldn't make sense to produce all of product B, right? So we really need to think about qualitative things as well. Let's take a look at another example. Nathan is comparing two different options. They currently are using option one. Option one provides them revenues of $61,000 per year, maintenance expenses of $4,700 per year, operating expenses of $24,400 per year. The second option provides revenues of $56,000 per year, maintenance of $47,000 per year, and operating expenses of $27,000 per year. Option one employs equipment that was upgraded 2 years ago at a cost of $16,000. If they choose option two, it will free up some resources that will bring in $4,000 of additional revenue. We are going to complete this table to show the change in income between option two and option one. Anything that is sunk will be designated S. Otherwise, we'll just put NA in that last blank where it's asking if it's a sunk cost. Looking through here, remember, a sunk cost is a cost that cannot be changed. It happened in the past. Nothing we can do today or in the future will cause that to change. Out of all of these, option one, these would not occur if we choose option two. So if we choose option two, all of these costs would not be there. These revenues and costs would not be there. So all of these are not sunk because what we do in the future will change these. However, this equipment was upgraded 2 years ago at a cost of $16,000. Nothing we can do now or in the future will change that, because no matter which option we choose, we can't change the fact that we spent $16,000 2 years ago. Okay, so comparing the two options to determine which has a higher net income. Option one has revenues of $61,000, maintenance expenses of $4,700, and operating expenses of $24,400. Additionally, it had an equipment upgrade of $16,000 in the past, which is a sunk cost, and we have to ignore it. It really shouldn't even be in here. Okay. If we do not choose option two, in other words, if we choose option one, we will incur an opportunity cost of $4,000 because option one does not allow us to bring in that additional $4,000 of revenue. So that $4,000 will be an opportunity cost. Option two, if it is chosen, brings in revenues of $56,000 per year, maintenance expenses of $4,700, and operating expenses of $20,700. We will not have the opportunity cost because we will actually have those revenues. So we don't have to have any opportunity cost in this one. Ultimately, what we have here is if we choose option two, stop doing option one, we will decrease our net income of $5,000. Maintenance costs do not change. Operating expenses will go down, offsetting some of our loss in net income. The equipment upgrade, we really should be seeing this as a $16,000 here because there's no difference between the two. It's a sunk cost. And then the opportunity cost causes our $4,000 to offset our loss in net income because we will not have that opportunity cost, helping to offset the decrease in revenues. So option two will actually cause net income to go up by $2,700. So management should go ahead and choose option two. We always want to keep in mind the qualitative factors. Don't really know what they are since they didn't tell us what these options are specifically centered around, but Financially, it may make sense to choose option 2 and stop doing option 1, but don't forget the qualitative.